Alrighty, folks, it is my pleasure to welcome you to the latest and greatest millionaire who will be coming back each and every week. We are so lucky to have the one and only Mr. Jason Hartman. How you doing, Jason?
Hey, good, Michael. It's good to see you as always.
Absolutely. This has been a long-term vision goal of mine to have you on the channel each week because you've been doing this so long. You are data-driven. You're not swayed by other people's opinions. You just know what you know, and I'm so happy you said yes to weekly conversations. Thank you so much.
Well, my pleasure, and I can't say I can do it every week like we talked about, but
we're gonna try. There you go. Well, let's just start with a really easy question. Obviously, I want to talk about the housing market today. We have stretched affordability, by many counts the second worst since 1981. We now are switching in some parts of the country from a seller's market to balance, from balance to buyers. And, price reductions are up to 40% of active listings. We're heading into the seasonally slow period. I just want to get a pulse check with Jason Hartman. What's going on in the U.S. housing market?
Yeah, it depends who you ask, of course. And when I say that, Michael, I don't mean that like it depends on someone's opinion only. Of course, it depends on that. But it also depends on the data because there are so many different surveys and they all have different methodologies. For example, inventory numbers, as we've talked about before, the National Association of Realtors has been compiling those probably for the longest of anybody. Their numbers calculate inventory differently than, say, Altos Research, as you know, and Redfin and Realtor.com also do it differently, right? And it's okay to use those different sources, but just stick with one so that when you ask yourself compared to what in time, if you're looking at the NAR data, then you look at today and you look at 2019 or 2015 and you get an accurate comparison. But none of these surveys, interestingly, compare to population growth or household formation growth. And they all need to be compared to that. It's just like when we talk about inflation, right? It seems like real estate is really expensive, and that's not untrue. But it's not as bad as people think when you adjust for inflation, right? So there are many layers to this onion. You always have to peel them back and look at that. But if you want to pop my screen up, we got a couple of charts I can show. So this chart is the Altos data on inventory. And as we can see here, inventory is up 24% from last year. But compared to what? Right? It was up 32% compared to last year. So inventory is actually declining. And what's interesting about the inventory decline is twofold. The way we want inventory to decline is by houses selling, right? And then it takes a house off the market because someone bought it. But what's interesting that's happening now is a lot of people are delisting their houses.
Exactly. Yes.
Which, I'd love to hear what you think about that. And I'll just kind of tell you a couple of my thoughts. Delistings have always happened throughout history, right? That's nothing new. But the amount of it is new, and it also varies from region to region and state to state and city to city. One of the higher delisting markets is the one I am sitting in right now, which is Scottsdale, Arizona.
I saw that.
What that means is people tried to sell their house. The market did not meet their expectations. They gave up. But they didn't necessarily give up out of desperation as they have in some years past. Now they gave up out of stubbornness and comfort. And what I mean by that is we all know about the lock-in effect. You and I have talked about that a lot, Michael. And the lock-in effect just refers to all of these tens of millions of Americans that have extremely cheap, super comfortable mortgages. They're not in any sort of distress at all, and they can afford to test the market. And I will personally tell you that I have been shopping for houses here in the Scottsdale, Arizona area. I used to live here. I moved to Florida for 7 years. I decided I wanted to move back here, and I've been making some offers. And let me tell you, these sellers are stubborn. They are giving me the finger. I mean, they just basically say, if your offer is not full price or close to it, we're not talking. I'm surprised.
Yeah, I think this is really interesting because this is something I talk to my audience a lot about. It's the difference between needing and wanting to sell.
Hmm.
And to be very clear, if you want to get down to brass tacks, this is exactly the opposite of the GFC.
Right,
One of the
right.
reasons
In
that
the global financial crisis, people were desperate. They needed to sell. Yeah.
Yeah. But again, let's break it down for folks at a personal financial level. Why did they need to sell in the GFC and they don't need to sell today? It really goes back to one simple thing, and that's shelter cost.
Yeah.
In the GFC, shelter costs shot up 2, 3, 400% because of adjustable rate mortgages. And in the GFC, it was financially prudent to walk away because you could rent the house down the street for 1,300 instead of paying $3,000. Today, we have the exact opposite.
Yeah.
You're in a house where the mortgage is, 1,300. And if you were going to rent like for like, it would be $3,000. So that's why we're seeing such a big jump in delistings. That's why we're seeing want to sell versus need to sell. But as we get through the rest of this year, it'll be very interesting because what I have predicted is delistings, the want to sell is going to increase. Thus, at some point, maybe even in Scottsdale, you're going to get to a level where a larger percentage of folks need to sell because there's always need to sell: death, divorce, job transfer, whatever.
Yeah.
And I think if you keep doing what you're doing for another couple of months, you're going to come back one day and go, you know what, Zuber, I got it. I got the one.
I got a deal. Yeah.
Yeah. I think it's a numbers game. So,
yeah, everything is a numbers game to some extent. There's no question, you are right about that. But it's just surprising to me how rich people are. When everybody's talking about how there's poverty and desperation, and we all know what the doomers say, and we all know that they're almost always wrong. I mean, the broken clock is right twice a day, as the saying goes. And if you predict disaster long enough, you're eventually going to be right? It's funny. I was doing a live stream with Peter Schiff. And listen, I like Peter Schiff. I mean, he's very smart. I call him the master of the soundbite. He's just got these zinger
he's
sound
good,
bites.
yeah.
And like philosophically, he's right. But from a philosophical level, do not always work out in practice that way, right? Because there are many other things going on. But when I say it surprises me how rich people are, I have looked at so many high-end, multi-million dollar homes in this market as I'm shopping, and they're vacant. And
wow.
I asked the listing agent, what are the sellers doing? Oh, they got another house in Paradise Valley and they just decided to move in there because they didn't want to deal with showings. I mean, it's like these people have a lot of money. They're not struggling. It's just interesting. But another thing I want to tell you about this particular market, and this applies to any snowbird market, I guess, but there's a lot of snowbirds that own second homes in Arizona, in Florida, in all these types of markets, right? In the Sun Belt, or the Smile States, as they're called sometimes. And I think particularly with the Canadian snowbirds, they may not be coming back in as high a quantity as they once did, because Canada's economy, number one, is a complete disaster. Their housing market is insanely expensive. But we'll see. There's trade tensions with Canada, obviously, over Trump's tariffs and so forth, which ultimately I agree with the tariffs. We need them, but it's not without problems, of course, and with the struggles in the Canadian economy, too.
Yeah, it is really interesting to kind of play this out because, again, I think what people miss from an economic perspective is that shelter cost. And again, a lot of people don't realize that, the Fed broke the housing market because they kept rates so low for so long.
Yeah.
They've created artificially low shelter rates. That's why nobody is, or very few people are desperate. There's always desperate people. But most people are like, hey, you're not going to give me my number? I'll stay put and I'll wait for the next guy.
Yeah. Yeah, absolutely. Hey, just back to the doomer thing, because I didn't finish my thought there. Sorry, I got off track.
Okay.
On my podcast and my YouTube channel, I call this a tangent alert because I tend to go off on tangents. Sorry. Anyway, my thought was I was doing this live stream with Peter Schiff, and he's a very smart guy, but he is mostly always wrong, right? And so one of the comments that came in, I was watching the comments because he was just talking and talking and talking, and it said, Peter Schiff's been wrong since 1982. That was pretty funny.
That's a long time. That's a long time.
But what happens here, and they've accused Harry Dent of this too, it's a technique called data dredging. If you just throw so much data at the wall, and you say things are going to collapse forever, you'll eventually be right. And so, Peter, for example, is saying, hey, he predicted the Great Recession and the housing bust in, 2007, 2008. But what he didn't say is he'd been predicting disaster for decades before that, right? So,
Right.
take
Yeah.
it,
Well,
take it for what it's worth, folks. Anyway,
I'll go one step further on the doomers, because I think we have a new generation. I think there are people like Peter Schiff and Harvey Dent and folks that just lean bearish. They sell bearish commentary. They've been doing it for decades. I think you and I are in a world now where YouTube creators are essentially learned that if you preach doom, negativity, and scary headlines, you can pay your rent. So I think there are some creators who don't give a rat's ass about being right. I believe Peter Schiff and Harry Dent want to be right. I think they truly believe it. These doomers that you and I deal with, they give a rat's ass about being right. They've been wrong for so long, but they're 5x our size and printing money. That the only way they can pay their rent, because they're failed mortgage brokers, they're failed appraisers, they're failed real estate agents, and they're selling their soul to pay the rent. And I guess hate the player and at the game. I don't know.
Look, it's dishonest.
Yes,
it's unethical. But it's also
profitable.
It is profitable to be a doomer for sure. But it's also very immature. Think about how immature you have to be to find one little piece of data and make a big doom video out of it. And then, tomorrow or next week, there's another piece of data and it says the opposite thing, right? It's like when you're a child, you live in the moment, right? Which, living in the moment is not always a bad thing. We should try to be more present in a way, but I'm not talking about that. I'm talking about being so swayed all the time and turning your ship every time there's some little headline that knocks you off course. Adults, hopefully, as they mature, they become bigger thinkers. They can see the big picture. They can keep plugging away toward a long-term goal rather than being swayed by, the shiny object, which is really what doomers are, right? I mean, I guess I'll say they're swayed by the gloomy object, right? Whatever this little piece of data is, oh my God, this is a sign, flashing recession. This happens before the housing bust. And, you know
what? I've actually come to the opinion that I don't actually blame the doomers.
Yeah.
I blame their followers, because what I think a follower of a doomer, and if you're watching a doomer, because again, I have the YouTube analytics and I can see the channels that people are watching. And if you're watching some of the classic doomers, I actually think you own that. The doomer would stop producing doom if it wasn't profitable.
That's a good point. Yeah. Just like saying really just bad news on the regular news station. If it bleeds, it leads, right?
Correct.
Don Henley's famous song, the lyrics go, the bubble-headed bleach blonde comes on at 5. She can tell you about the plane crash with a gleam in her eyes. It's interesting when people die, they like dirty laundry, right? Yep. And that song is such a good lesson for all of us is, we need to not be seduced by that, right?
Correct. I think some people want permission to do nothing. That's what I've come to realize.
Yeah.
And if you're somebody who wants permission to do nothing, I got nothing for you. Because I believe in extreme ownership. I believe wealth can happen to anyone, but it takes time, discipline, and a decade. But if you want permission to do nothing, guess what? Go watch that idiot broke doomer. And, I will keep talking to people that want to build wealth. I got nothing for those people.
Yeah, no, that's a good point. There's lots of Nick Jarellis out there. And
exactly. He's getting copycatted every day.
Yeah, it's amazing. Hey, let's just look at this chart though for a second in a little more detail, because I got another chart for you. So, and this is the Altos stats. We're hovering around 800,000 homes for sale in the United States, actual active listings. That's why I think these stats are the most important to look at. And the question is, compared to what? Sure, it's much higher than it was in the COVID era, where we got down to about 240,000 houses. But the overall housing stock in the country is about 140 million. So this is slightly over 0.5% of the inventory being for sale right now. And in several markets, we are seeing some slight price declines in a small number of markets. Overall, I think that's about, depending on what study you look at, about 30 markets out of 200 studied. It depends. Are we studying every MSA? Are we studying every city, county? It's complicated, okay? But, this is far from what you would call a crash, right?
Mm-hmm.
The real estate crash is closest to happening in Austin, Texas, right? That's the closest market to a
Agreed.
crash, and it's still not a crash, okay? And you got to remember, people made fortunes there over the last few years, okay? It's like saying, okay, I've got the fastest car in the drag race, right? And, my dragster is the fastest. Okay, well, I slowed down a little bit, okay,
Mm-hmm.
but I still,
Yeah.
it's just compared to what, anyway, I
Yeah.
don't know. My example's probably not that great, but you
No,
get
it
the
works.
idea.
It works. Yeah.
This is realtor.com, and it's the same basic chart, but why are
Mm-hmm.
the numbers different, right? This chart shows you that we've got about 1.1 million homes for sale in the country, whereas this chart shows you we've got about 800,000. Why is it different? Well, it's different because they have different methodologies. And I'm going to use NAR as the best example because I'm not super familiar with realtor.com's methodology. Now, realtor.com, I believe, originally was owned by NAR. Realtor is a trademark of the National Association of Realtors, but I think they spun it off. Anyway, NAR, their data includes active listings, pending listings, and contingent sales.
Correct.
They call all three of those categories as available. Okay. Altos only uses active listings,
Correct.
which are the only ones you can really buy today. So I think their stats are cleaner for sure. Yeah.
No, I would agree with that. Yeah. Again, when you're looking at this different data points and you have doomers peeling back one piece and not doing apples to apples, you really got to look behind the scenes and we see it all the time, but the average person probably misses it.
Yeah, they do. And when you don't understand this and you don't study it all day, and listen, for whoever's listening, I don't blame you for, like, I don't understand a lot of things I don't study every day. If you ask me about medicine or, supply chain management, I couldn't tell you much about that. I'm a spectator. But,
right.
Michael and I do this for a living. I'm sure you're like me, Michael. I read for like 2 hours every morning.
Every morning.
I just read newsletters and look at stats. And I always try to ask myself, whenever someone presents data to me, they present a chart, they present something, I always try to ask myself, what is the chart not telling me? What isn't there? There's a saying I talk about a lot on my podcast and my YouTube channel, and it's a super important concept. And it comes from a Sherlock Holmes episode. And the saying is, you can't hear the dogs that don't bark. You can't hear the dogs that don't bark. Now, I'm a dog lover. I've always had dogs. And, you can't hear the dogs that don't bark. And what happened in this Sherlock Holmes episode is there was a murder. And Sherlock Holmes was investigating it. And one of the clues was that the dog didn't bark when the murderer was there, right? Well, why didn't the dog bark? Because the dog knew the assailant, okay? And, there's lots of dogs not barking, and you always have to ask yourself, what isn't barking, right? What aren't you being told? What aren't you seeing? Sometimes the most profound impact is what is unseen or what doesn't happen. Can be more profound than when we, as humans, we notice what does happen. We notice what we see. But a lot of times we don't notice what we don't see, or we don't think much about what didn't happen, what might have happened, right?
Yeah, the one question I want to ask you, and I'm glad I get this opportunity on a video, is do you think we have started a slippery slope where the U.S. in a decade, into maybe even 3 decades, becomes a renter nation? And I'll define a renter nation as greater than 50%. I think the last home ownership I saw was about 64%. So do you think we're just headed that way, that we're going to be a renter nation at some point?
That is a great question, Michael, and I have pondered it a lot. And the big institutions are definitely buying up America, and you got to ask yourself, if they are the smart money, these big institutions like BlackRock or Invitation Homes, right, that owns tens of thousands of single family homes, if they're the smart money, they've got all these MBAs, all these financial engineers, all these forecasters working for them. Maybe you should follow their lead. Okay, just maybe they know more than you do. Okay, and they're buying up single family homes like hotcakes. Okay, so yeah, I do think that renting is becoming more popular, and I don't think that's all bad. So let's ask ourselves, compared to what? During the George Bush era of ownership, which I think was a mistake that was a partial cause for the Great Recession, we got up to about 69% home ownership rate. 69% of adults owned a home.
Mhm.
And now we're at about 64%, like you said. I've always said, I've never changed my opinion. I've been doing my podcast for 20 years now, and I never changed my opinion that I believe the natural home ownership rate in America is about 55%.
Oh, wow.
Okay.
Okay.
I think that is the natural rate if you take away all these crazy incentives that we have for home ownership and all this kind of stuff, right?
Hmm.
And one of the things we've got to remember is that if the home ownership rate goes down and we own investment properties, there's going to be upward pressure on rents,
For
okay?
sure.
Because there will be a larger rental pool. So either way, as investors, we can make money. We just have to adjust our strategy. Are we in a capital gains market, an appreciation market, or are we in a rent appreciation market where it's more of a cash flow increase market? And either way, it's a multidimensional asset. But I do think you're right. I do think the homeownership rate is trending downward. I don't think millennials are very interested in homeownership the way their baby boomer parents were, or my generation, and probably yours, Gen X, is. So, I think people have discovered there are many other investments, and I don't have to own a home to get rich necessarily. That's been a very stable way to increase your wealth over the decades. But, a lot of people say, just buy Bitcoin, or something. And
Yeah.
look, that's pretty speculative, but who knows,
Hey, it's worked out for anybody who got in a few years ago. It's
It sure has. It sure has.
there you
Yeah.
go.
Can I just say one more thing about the
Yep.
homeownership thing? So I want your people, and maybe you, to think about this in a new way. There
Okay.
was this big cover story in Newsweek magazine about, I want to say about 14 years ago.
Oh, okay.
And it talked about homeownership. And one of the studies they cited was that in areas with high homeownership, there tended to be higher unemployment. And I thought that was really interesting. Isn't it great to own a home? Shouldn't we all have a goal of owning a home?
Hmm.
And what they talked about in this study is that people cannot move to where the jobs are.
Mobility.
And when you own a home, it ties you down. Okay. And as I said, coming out of the Great Recession, the best thing you can have on a resume is mobility, to be able to move to where the jobs are. Right. So homeownership isn't all it's cracked up to be. It's not like the end all be all, okay? Own investment property, own property for sure, but property you can rent out to somebody else. You don't need to live in the house that you own necessarily.
Love that, Jason. Well, I'm so happy we get to talk to you each and every Monday, most Mondays. Obviously, we will miss some, but also you are a featured speaker at our upcoming Vegas event. So a lot of people are going to get to know you over the next several months, and I'm sure you have a large ORAT fan base. Jason, where can people find you?
JasonHartman.com, or my podcast or YouTube channel. Just type in my name on any podcast platform or on YouTube and you'll find me there.
There you go, Jason. Take care. Thank you so much.
Thanks, Michael. Happy investing.